Hi, it's the middle of March 2019. This is Michael Shinisky of Trendhaven Investment Management with a few words about investment risk. The traditional and dominant approach to describing and assigning risk to investing is an asset-based approach under the assumption that your future investment returns and the volatility of your portfolio's value can be planned by looking at the past. An alternative to this is to recognize that your investment risk varies with your investment goals. I think that acceptable investment risk is a function of your age, wealth, and disposition. Traditional risk management has as its goal optimizing risk and return. Risk is managed via diversification, anchored by stock and bond allocations largely in a process of buy and hold investing. An alternative to this is to have the goal of minimizing your maximum regret. Risk varies with investment goals, and it can include both passive or active investing. Now, I'm sorry to start off with such a geeky looking chart, but this chart shows curves known as the efficient frontier, which are meant to capture the average returns and risk as measured with volatility, both upside and downside, for different allocations to stocks and bonds. The gray and orange curve here in the middle is the average over 65 years through 2014. As you can see, by looking at all the other curves for different decades, the risk and return profile of stock bond allocations changes dramatically over time. Unfortunately for investors and their advisors, looking at the past profile of investment risk and return isn't likely to tell you much about the risk and return of any particular stock and bond allocation going forward. Yet, that's the dominant practice. It's based on modern portfolio theory, buy and hold investing, and, in my opinion, the use of the investment advisory industry as a marketing arm of the investment company industry, which is selling mutual funds and ETFs. One good example would be, let's say you're standing in 2010 and you're looking back at the previous decade, either selecting an acceptable level of risk or attempting to minimize your risk. You would have selected a stock bond allocation that would not have been appropriate for your stated risk management goals going forward. Not even close. Now, because the approach offered by modern portfolio theory supplies precision without accuracy, you'd be better served by attempting to minimize your maximum regret. After all, most investors had to work hard to produce the savings that are the investment capital that's at risk. Your maximum regret is influenced by your age, your wealth, and your disposition. For example, a less wealthy investor, either in or approaching their retirement years, probably fears losing the value of their investment portfolio. Or a wealthier contemporary might be concerned with the size of their legacy. On the other hand, a young and wealthy investor may fear missing out on the bull market returns and would be disturbed if they didn't realize investment returns as good as other investors were getting. For them, risk is about relative returns. There are many older, wealthy investors who just never want to underperform the market or their peers. And they have enough assets to weather any expected periods of drawdown in investment value. One thing's for sure, allowing your maximum regret to flip-flop between fear of loss and fear of missing out will likely result in long-term underperformance. A fully invested buy and hold investor may become so distressed in a major market correction that they sell after realizing most of the losses and then remain out of the market long after it's rebounded. Conversely, conservative investors may abandon their safer strategies when they become envious of a bull market in stocks. To better understand what kind of investment risk you're really assuming, it's helpful to delineate the risks associated with different investment goals and approaches. These can be differentiated by the extent to which they're passive or active, and whether they rely upon asset class selection or market directional expectations. Those who seek beta are expecting to be happy with the average return of the aggregate market. Those who seek alpha will only be satisfied if they do better than the average. And those who seek absolute return desire steady advancement of their portfolio value over time. The principal risks are quite different. Market risk is taken by seekers of beta and it's macroeconomic in nature, and it's increasingly impacted by the political influences on central bank policies. Manager risk, assumed by seekers of alpha, is idiosyncratic and quite variable. Model risk, taken by seekers of absolute return, can be very hard to ascertain, but should rely upon lengthy histories of successful implementations. Let's take a look at each. If you're taking market risk, you should expect that your long-term returns should be equal to or better than inflation. However, you should also expect that you're going to participate in a major market correction every 7 to 8 years, that you could be in drawdown and recovery for 3 to 5 years or perhaps even longer, but you should be able to access this strategy for very low fees. Now, most investors today are relatively unconcerned with the possible extent and duration of drawdown. We don't think that the 15 years of drawdown and recovery of the S&P 500 after the Depression could ever happen again. Most don't even think about the 7 years of drawdown in the mid to late 1970s. And of course, real estate values can only go up, right? I guess the poster child of drawdown is Japan's Nikkei stock average, which is still only worth about half of what it was in December of 1989, 29 years later. You may want to think about that the next time your advisor says to you, "Don't worry, we're in this for the long term." This chart shows the drawdown and recovery associated with the last two major market corrections, impacting a 60-40 stock bond portfolio using two well-known indexes. During the bursting of the tech bubble, you would have been in drawdown and recovery for 4.3 years, whereas the absolute return strategy, such as the one that I'm running, would have had a return of 46% during that period. In the financial crisis, you would have been in drawdown and recovery for 3.7 years, whereas the absolute return approach, such as the one that I'm running, would have gained 80%. Now, both of these last two market corrections were met with a 5.5% reduction in the Fed funds rate and extensive levels of quantitative easing to shorten the drawdown recovery periods. Right now, the Fed funds rate sits at about 2.5%, so the Fed won't be able to do that the next time. The implication is that the next time we see a major market correction, it may take a much longer time to recover. Alpha seekers taking manager risk should recognize that there's a widely demonstrated lack of persistence in the performance of active managers. The best recent performers have a less than random chance of being a good performer going forward. Now, you should be able to get long-term returns that are maybe equal to, maybe a little less than indexing on average, but there's little or no downside protection, and there will be higher fees. Those pursuing an absolute return goal should recognize that more downside protection may not come with better long-term average returns than passive investing, but it certainly will involve higher fees. So, what is right for you? It comes down to your age, your wealth, and your disposition. There are plenty of beta and alpha strategies to choose from. Successful absolute return strategies are harder to find. But at this point, we're 10 years into an aging bull market. Given your situation, what would be your maximum regret? Thanks for listening.